Here are 12 common mistakes that traders make, but more importantly is how do we fix them. The first one is over leveraging. These are three things that you need to decide before you trade. What percentage of your margin will you trade today within a 2 to 5% total of your total margin? In other words, if you got $10,000 in there, what is 2% or what is 5% of that? And that is the maximum you will put on in the sum total of your trades. We discussed this at length in our bi-weekly advanced class. If you are not getting an invitation to that, go to the website, go to contact us, and send us an email, and we'll get you invited. Now, what percentage will you risk on any one trade? Let's assume you have $200 that you can risk today. Are you going to put all $200 on one trade, or are you going to put it in 2 or 3 different trades, spread it around a little bit? Then what is your maximum daily loss in dollars where you will stop and not trade anymore? In other words, if you say, listen, when I get $100, I've had $100 in losses today, I'm quitting, I'm going to shut the charts down, I'm going to walk away. You have to be willing to limit your risk. Everybody gets in a little funk now and then and can't seem to trade their way out of a wet paper bag. And on days like that, you need to limit your risk to a dollar amount. Number 2, thinking that the PATOs and the HMIs are crystal balls. All indicators, including PATOs and HMIs, are lagging indicators. That means that they tell you what is happening, not what will happen. You should think of them as confirmers, not forecasters. They confirm that the setup is there, but they cannot forecast the future. Lots of things, like the things we're going to discuss in this tutorial, can stop a movement dead. Number 3, not looking at the big picture. Okay, you've got a great 6 aces trade setup going up. However, the red moving average on the wild card is headed down. Instead of realizing that unless this is an actual reversal, it is not going to go too far, instead of waiting for the reaction to the strong side of the trade, in this case it would be down, you enter anyway. You try and stay in instead of moving your stop every time it pulses up, and you take a loss or a break even on the trade. The solution? Wait, 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 and when you get tired of that, wait some more. So here's an example. You enter here due to the white dot on the bottom right there telling you that you're going up, and you have a valid 6 aces trade going into the desert. Okay? However, the trend has shifted down, and the red moving average is confirming that and showing it to you right here on the chart. Alright, the result is you take a loss. By the way, notice this bear flag, which is a clear pattern to the downside. So you should have been aware of that. Number 4, not understanding the power of previous support or resistance. You see a perfectly good setup, a wild card, a 6 aces or a royal flush, and you take it based on the setup alone. You have not looked at what the market did in this previous price area on a larger chart, a 60 or 240. You might even have to go to a day chart. The trade slams into previous support or resistance and stops dead, resulting in a loss for you. Here's the solution. Before trading, always look what the market did before in this area. Big boys are creatures of habit, and they like to do what they've already done. That is the safe way to trade. So, here we go. You enter here due to a white dot on the bottom and a valid wildcard signal. The market immediately reverses on you and you lose. What happened? Wasn't it a valid wildcard? Sure it was. But let's take a look on the 60-minute chart. Here's the view from the 60, and you can see right over here that you bought right into previous support and the market reversed. The market stopped here before. If it stopped here before, it will most likely stop here again. The better trade was to wait for the 6 aces reversal back into the desert. Waiting is the hardest thing to do in trading. 5. Trading into a T30. You see a perfectly good setup, a wild card, a 6 aces, or a royal flush, and you take it based on the setup alone. You have not seen that the T30 is not far enough away to pay the broker and also make a profit. You put a 30 pip stop on the trade rather than following your margin rules of 1-to-1 risk to reward. In other words, if you're going to trade for 30 pips, you can put a 30 pip stop, but you can't put a 40 pip stop on a 30 pip trade. It hits the T30 and reverses the direction and takes your stop out. Here's the solution. Always be aware of where the next T30 is and make sure that if it respects the T30, you will still make a profit after paying the broker. And never put a stop larger than your target. If you do that, you won't be able to trade at the T30s. So here's an example. Okay, there's our white dot telling us we're good to go up. Here's our signal. Okay, wow, we got it, let's take it. We take the trade and boom, we slam right into a T30 and it rocks back out and it stops us out right here. And you see it continued on up another 50 pips, but we took it at the wrong place. Number 6, clicking out for too few pips. This is the number one problem for traders. You see a perfectly good setup and you take it based on the setup. You do not use the PAT projector to find the target for this pulse of energy coming into the market. Big boys try and go for 55 pips, and the earlier in the move, the better the probability that they will hit that 55 pips. You click out for 5 to 8 pips thinking you're a winner. You now must be right 90% of the time to increase your margin account. So you won the battle, but you just lost the war. The solution: at the first wild card or 6 aces of the session, use the PAT projector and then do everything you can to stay in to the 55 pip limit. So here's a trade right here. Here's the New York Open. So our first trade is right here. We get an arrow and a painted candle up. Okay? You click out here. Why? Because the candle's going the opposite way and I'm scared. The result would have been 55 plus pips. So always use the PAT projector so that you can stay in for 55 pips. Even though it pulled back right here a little ways, it went ahead and took out the target. So at market open, do not be in a hurry to move your stop. A lot of traders get a trade going, and as soon as it goes up to 8 pips, they move their stop and get stopped out. It's the beginning of the session. You have 2 to 2.5 hours to hit your target. It's not going to hit it normally in the first 5 minutes of the trading session. So leave the stop alone until the market moves out. You can give it 15 or 20 pips here before you move your stop up to break even.